Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, everyone, and thank you for tuning in to another episode of No More, Risk Better. I'm your host, Zach Griffiths, head of U.S. investment grade and macro strategy at CreditSights, and I'm very excited to be joined by my colleague, Zerlina Zeng, our head of APAC strategy over in Singapore, taking time late evening on April 21st. I think that's very important when we're going to be talking about markets to timestamp what we're discussing, as there are plenty of moving pieces. Zerlina, thank you so much for coming back on the podcast.
Thanks for having me again, Zach.
All right, so as I mentioned, it's April 21st. We have U.S. delegates in Pakistan to discuss a ceasefire, which is set to expire today. Zerlina, last time we talked was February 9th. Wasn't that long ago. Feels like a lifetime ago. Markets have certainly shifted quite a bit in some pockets of financial markets. I'd say the biggest moves since the Iran war began are really in energy prices. That's not going to be surprising to anyone. But the other big one is government bond yields, certainly across G10 have moved higher and really across the globe in various markets. And it's been interesting comparing this time period to what we saw in 2022 with Russia and Ukraine, while at the same time credit spreads remain tight. It seems like risk assets have responded more to positive news, while energy prices remain elevated, government bond yields remain elevated. I'm just coming back from vacation last week. It's hard for me to get back into these markets when it seems to still be very headline driven. So with all of that, hopefully useful level set, the last time we spoke, Zerlina, I started with a consideration of the return of the Sell America trade. I know that you were just over in Korea and China. With everything happening in Iran and how the U.S. is handling foreign policy from that perspective, are you again hearing more of the Sell America consideration on this recent trip you did?
Yeah, so when I was in Korea and in mainland China, and the weather was super cold and headlines were very chaotic. So overall, I didn't feel that great, but the risk sentiments in these two markets were surprisingly great. In Korea, March, we all know the Kospi had a 20%, more than 20% of drawdown. But still, year-to-date, Kospi is up 50%, and last year it was at 75%. What we heard from the fixed income asset managers was they saw very intense competition from the Korean onshore equities. Right now, even the lifers, some of the SME corporate treasury desks, they don't want to do fixed income. Either dollar or to some extent Korean won onshore papers as well. Everybody is super excited about Korean equities, and they see March as a great chance for them to bottom fish the Kospi and some of the Korean Kosdaq tech companies. So the general competition for money away from fixed income investment was quite a theme in Korea. We were told last year was quite a big year for fixed income, especially for investment allocated to U.S. high yield, U.S. private credit. Not so much for the case this year. And compared with the U.S. fixed income investment, they also mentioned the Korean won onshore rates have gone up quite a bit, and now they see quite a lot of value there, especially given the USD hedging cost is still very high. Korean won depreciated a bit in March against the dollar. But a lot of investors in Korea, surprisingly, they took profit on their USD fixed income portfolio, then reallocated those investments into either onshore equities or the onshore Korean won, Korean papers. So they expect this trend to continue for the rest of the year, and it looks like the fixed income managers are giving a slightly gloomy picture about their fund inflows. For those still with existing USD positions, they deploy a quite interesting barbell strategy when it's come to credit risk. So a very large chunk of the portfolio is allocated to US Treasuries. Some of them mentioned even 65%. Then on the other side, they're doing quite a lot of US special sits, APAC special sits, private placements, convertible bonds, to reduce basically market beta. And these portfolio has returned quite decent, 6 to 8% of the past 12 months. Even with that type of return, they still mentioned they cannot compete with Korean equities, and everybody still wants to get some equities. Overall, they are underweight credit risk, market risk, and they want to reduce the market beta. Some of the Korean life insurance companies are still looking to stay up in credit quality. A and above are the go-to destinations. They want to stay duration neutral or adding slightly a little bit of duration, but no more the index duration. Some of them mentioned about investment in JGBs, given the yields are higher now, and some interest in Australian dollar. I think when it comes to mainland China, people are also staying a bit cautious about dollar fixed income investment, but for slightly different reasons. Overall, there is a still very strong demand for Chinese money to go offshore, given the onshore CNY yields are very low and the domestic liquidity is abundant. And people find it very difficult to find good ROEs on fixed income investment. Regulatory measures are also gradually expanding offshore investment channels through the QD funds, and also the regulators increased eligibility for southbound connect that investment scheme. But overall, the regulatory direction is for these offshore, for these money to be channeled offshore to invest in the CNH bond market in order to support the development of RMB internationalization. On the issuer side, the regulators are encouraging Chinese issuers to issue CNH bonds or dim sum bonds to refinance their dollar bonds. When it comes to investors, the regulators are issuing some window guidance saying no leverage position investing in US treasuries is not encouraged, even if these Chinese accounts, they did make very good money last year on their leveraged positions in US treasuries, but it's still not encouraged by the regulators. A lot of them are encouraged to do more dim sum bonds or Hong Kong dollar bonds. I think in the mainland China market, the different Chinese accounts are getting more sophisticated, and there is a quite wide range in terms of the investment style and risk appetite. For those early movers for overseas investments, such as the big QD funds, some of the lifers and securities companies, now they have quite broad exposure to global IG market, and they are still looking to allocate a bit more investment into this space, given the depth and breadth of the USD fixed income market. Now they're also doing a bit more EM, particularly LATAM. They like IG rated LATAM or Brazil. They're also looking at opportunities in CEMEA, looking for opportunities in non-dollar denominated fixed income products, particularly AUD corporate bonds and some Euro bonds. They're also looking at securitized products, MBS, the MBS in the US. EM Asia is accounting for a smaller and smaller percentage of their overall portfolio, given the persistent net negative supply of the past few years. And their total return request is not particularly high, about 4.5 to 5% overall of total return, that type of mandate. So I think it's a very mixed and quickly evolving market. People are quickly deploying money to somewhere they see opportunity. But at this point, I think they're also taking a pause, whether it's because of risk management given the market volatility, or it's because of a regulatory window guidance.
I want to go back. I should know more about this, but what is the story behind the huge run-up in Korean equities and perhaps the sell-off earlier this year? I think we've kind of rebounded off of it, but what's the kind of quick digest in terms of what's going on in Korea? And you mentioned also higher rates locally, which might be an important consideration for overall global demand or lack thereof if there are more attractive or still attractive opportunities locally in Korea.
Yeah, I think on the equity side, it's mainly an AI story. If you look at the Kospi index, it was really led by the semiconductor producers or the memory manufacturer, SK Hynix and Samsung. They are the leading indicators for the Korean Kospi market now. This AI trend is still riding pretty high this year. I think the U.S. equities to some extent is also kind of driven by AI-related stories. Same in Asia, and it's also a similar story in the Taiwanese equity market, as well as Hong Kong and China market for some AI-related stories. And people like to use Asian, semiconductor makers or AI-related value chain players as an effective hedge against U.S. equity, an AI equity story, or to some extent fixed income story. We do see investors investing in Korea semiconductor manufacturer dollar bonds and equities, and Chinese big tech players on hyperscalers as an effective hedge against U.S. market exposure. This year, I think it was an in general market correction in March, to some extent driven largely by foreign institutional investors. I think for weeks, 2 to 3 weeks, almost every day, we saw an outflow from foreign institutional investors out of the Korean equity market. But if you look at the domestic retail investors and institutional investors, they're still putting money into the domestic equity market. People still have relatively high confidence of the domestic equity market. The other end goal is because last year they elected a new president, and this president is more equity market friendly, talking about improving the shareholder returns, improving the deeply trapped values in the Korean equity market. He's saying the Korean equity market is undervalued compared with other development markets. So he also pushed out a lot of friendly policy towards different industries. So I think all these is boosting the sentiment towards the onshore equity market. The Korean rates market are, I think it's last year they had a very good rally. There were a lot of receiving positions for the Korean rates, and people are quite confident on the Korean treasury bills as well as government bonds because of the index inclusion. This year, there are still continued inflow related to this index inclusion, both passive and active. But overall, higher yields are attracting a lot of treasury desks in the onshore market, as well as asset managers and lifers to rethinking their asset allocation. But ultimately, I don't see this as a big sign of sell America trades in the Korea market, because the local bond market, the depths and breadth are quite limited. What we could see is for Korean issuers, they are still coming to the dollar bond market for their funding needs, especially those automakers, semiconductor manufacturers, steel makers. They still have huge funding needs, and most of it cannot be met by the domestic bond market or the loan market. I think Korean issuers are the still most active issuing segment from all the APAC issuing markets. So we expect this trend to continue.
That's helpful. And so in general, sentiment seems pretty solid. I'd be curious to hear, in the US, it's all about private credit, even throughout the war, even when the war first broke out. Both Winnie and I were finding in our meetings, people wanted to talk about private credit more than the war, which was kind of shocking to me, just because at least in the early days, I think the war was quite a bit of a surprise. Obviously, there had been signs we were moving that direction, but maybe this has kind of ultimately transpired in a more intense way than some may have anticipated. So, what's your sense of the concerns over there? Are there many? I mean, I guess if there risk sentiment is pretty solid, then maybe they've kind of moved past the Iran war as there's a bit of fatigue, kind of like what we saw with tariffs in 2025. And I'd imagine that the private credit exposure is quite a bit more limited. But how did those risk conversations go for you?
Yeah, I think in Korea, the exposure to Middle East credit markets was quite limited before the war. So people are in general not so concerned. In Korea, it's also quite heavily dependent on the imported energy from the Middle East, but they do have very big stockpile of energy, both crude and refined oil products, and the domestic electricity generating companies. They're basically KEPCO and K-Gas and K-Oil. These SOEs, they are required by the regulator to absorb certain electricity pass through of the electricity costs. So, and in terms of the inflation impact and growth impacts, I also don't see that many concerns. For the Chinese investors before the war, over the past 12 months, I think they have ramped up position in Middle East dollar credits, mainly in UAE, Qatar, and Saudi. I do see people doing a little bit of adjustment of their risk position, especially if their portfolio weight is more than 20-25%. I see these investors trimming down a bit of the risk exposure, but overall, Chinese investors still have very strong conviction on the prospects of Middle East macro and credit markets. I don't see a complete exit from the region, and people are still talking about they see value in the first tier banks, seniors, and tier two. They still see value in the largest quasis like Saudi Aramco, Saudi Electricity, Qatar Energy. They would see that as a buying opportunity. So I think people are overall looking through all the chaotic headlines. They still see medium to long-term opportunity in the region. Now, private credit, I think it's really front and center in all my conversations. I was a little bit shocked that across all my client meetings, private credit, this type of discussion, are about 30% or even sometimes 50% of my meeting time. I think the exposure are mainly twofold. The first is most of the Korean and Chinese investors, they see GC banks and US banks are relatively safe investments. And most of them have senior papers, senior TLAC. Some of them have tier 2 and AT1 papers. So their core portfolio holdings are the global banks. And they want to understand what is the systematic impact, what's the impact for the different Japanese, US, and European banks. I think overall, people do agree with our view that over the next 6 to 12 months, we're probably not going to see a very big systematic impact because after all, this market is not so big. But they're also a little bit skeptical of the disclosure, especially by European banks, some of the Japanese mega banks and insurance companies. So people want to understand where we are standing at the private credit cycle, whether the risk management disclosure and the loss provision are adequate at some of the European banks who are at the news headlines. They also want to understand whether we will see a liquidity crunch because of the past few years. If a high yield corporate cannot issue in the public bond market, maybe it can go to BSL or private credit. But if these two doors are shut, what would be the implication for the liquidity, especially when borrowing costs are still very elevated? I think this would be also a question for you, Zach, because a lot of the Asian investors are trying to understand this. Another angle is I think some Korea life insurance companies and asset managers, they do have some small exposure to the private credit market. I would say most of that are through fund of funds investments. Based on how they monitor the portfolio, they think the current credit stance of their underlying loans or private credits are still relatively solid. And after all, it's a very diversified investment. I do see some Korean investors are trimming or getting out of their BDC investments, and they're also holding their co-investments, direct lending, that type of private credit business. So I think they are also trying to understand how should they better monitor the private credit portfolio. What are some of the metrics that they should be looking at on a forward-looking basis?
It's interesting. I think from a global bank's perspective, we're quite comfortable with the amount of exposure. And when we look at the fundamentals in private credit, using our colleagues at Fitch Ratings that has a great data set, you are seeing defaults moving higher. I think our issue is more you're going to see more challenged returns, and that's already been the case if you adjust returns in high yield bond, leverage loan, and private credit markets for different leverage levels. There's higher leverage in private credit, and so over the past 2 or 3 years, those returns after adjusting for unit of leverage have been much more attractive in the high yield bond market in the US relative to private credit. And we think that that situation could probably persist and become more pronounced. And so I think weakening returns, no one likes it, but that's not going to take down a financial system and certainly is not going to be a problem for the banks that are generally in a very solid position and facing probably the most constructive regulatory backdrop that they've seen in the past 15, almost 20 years now. So I think that there are going to be challenges. There's going to continue to be headlines. There may be fundraising challenges for these semi-liquid BDC structures going forward. But in terms of our biggest concern, and I think you highlighted it well, Zerlina, is if we were to face an environment where the public capital markets start to feel shakier the way they were in 22 and 23 as the Fed and other major central banks hiked rates aggressively, it seems like private credit's not going to be there as that liquidity, as a source of liquidity the way it was then. And I think that then you have borrowers that are forced to go to market at either very elevated spreads or overall borrowing costs, and that could become a problem. So that's definitely something that we're concerned about, but is not. We don't think it's going to be a problem for the large regulated institutions globally or in the U.S. And so shifting gears a little bit, I know that U.S. macro is always a big focal point. There's obviously a lot of headlines. What were some of the biggest U.S. rates and macro questions you got? And maybe I can offer some of our latest thoughts on those based on kind of what sort of pushback or follow-up questions you got, kind of taking our views out to clients.
Yeah, I think the biggest pushback I've got from both Korean and Chinese investors are our overweight recommendation for long end US Treasury. The concerns are mainly they're saying the recent beta with US equities are very high. So US Treasuries are basically not safe haven, but more trading like a risk asset. They're concerned about US deficit, supply risk, concerns about Kevin Walsh Fed balance sheet reduction. I know you have extensively write on all these, and we also try to convey some of the talking points to the clients. But overall, I think the conviction level among clients are very low in terms of how they could trade the long end of US Treasury or what their duration strategy should be over the short term and medium term. People are also a little bit confused about the recent US activity data print and inflation print or the retail sales. It just looks on the surface, everything is very strong. And at the same time, it's hard for them to digest why the market is still pricing in 20 to 25% of US recession risk in the second half of the year. Even the labor market on the surface looks like not too bad given the unemployment rate is not so high. Then we still get clients has a very strong belief in the implication for AI capex on growth. So I think this is still the biggest pushback we have got so far. People are very hesitant to overweight duration at this moment given the market volatility. I think the second is more an open-ended question. Everybody are complaining spreads are very tight and they're just going tighter and tighter despite all the market conditions. we have forecasted excess return to be pretty much negative across all the global fixed income markets. So people are wonder how for excess return mandates can hedge the portfolio or for somewhat to make the overall return positive. In Asia, we keep saying diversifying across different markets or expanding a bit into the non-USD space as Australian dollar, Sing dollar, CNH. These are some of the suggestions we gave. People in general do not want to take a CDS, that type of position, because of the negative carry. So yeah, it's more an open-end question for you.
Yeah, I certainly understand the wall of worry in terms of long duration. And I think the way, since the war, it's been very challenging. I agree. Treasuries have been trading more like a risk asset. Treasuries have been a very poor hedge for U.S. equities. They've been trading in line. U.S. deficit, I think that's a big one, although the current Treasury seems a lot more comfortable financing the deficit and debt with T-bills, while at the same time you have the Fed buying T-bills, perhaps to a lesser degree, but we could see the Fed potentially buying across the curve. Now that's an interesting debate to have with Kevin Warsh coming in and having well-publicized views about preferring a smaller balance sheet, and we put out a good piece on that. Working with our banks team, it does seem like the key to the Fed actually reducing its balance sheet is on the regulatory side for banks and reducing their demand for reserves. So it does seem like the groundwork is being laid for that. Ultimately, we don't think that the Fed is going to be able to, or Kevin Warsh will ultimately want to shrink it so dramatically that it becomes a huge problem for the Treasury market. He's also talked about a Treasury Fed accord. And so there are a lot of moving pieces, especially with the potential incoming Fed chair, and we'll be hearing from him today. So there's a lot to digest. I think the key thing for us, how we differ from what my perception of market consensus is again more concerned about the labor market. I've been pointing out in client meetings, the U.S. economy added just 116,000 new jobs in 2025. That's like one decent month. Not even that decent. If you go back to in the 2010s, I feel like 150 to 200 was kind of what felt like a good print for payrolls. And so this curious balance, as Chairman Powell has put it, in the labor market, we ultimately expect it to become imbalanced on the negative side. We do look for the unemployment rate to rise, but having a lot of conviction in this market is certainly difficult to do. We definitely take the complaints or concern about very tight credit spreads to heart. And, in a lot of our meetings, it ultimately comes down to more people are happy with all-in yield levels. And so that's been kind of a challenging environment to actually see spreads widen. Now, with our base case of the 10-year going to 375, IG spreads going to 110, I do think you probably need Treasury yields to move lower to get those wider spreads. And we did update our Fed call. We now expect just one cut this year. That's more of a timing thing as the war has kind of complicated the path for the Fed and limits their ability to address what we think is a weak and weakening further labor market given the inflation concerns. I point out in February, I think that was more of what we had expected to see this year. You saw equities selling off a little bit, treasuries rallying. I think we got down to 394 on the 10-year before the war. So I feel a little bit vindicated about some of our views. You kind of have to throw that playbook out now that the Iran war is here and continuing, at least in the near term. But we do ultimately think you get a Fed that has to ease, a labor market that weakens further, and a consumer that is seeing expected benefits from tax cuts being completely offset by the increase in energy costs. We are working on a piece to sort of address best ways to implement some of our views or ways to hedge this market, potentially looking at ETFs and maybe even options on ETFs to kind of get to your excess return. How do we make the overall return positive if people don't want to get into CDS because of negative carry there? So stay tuned to our subscribers on that. And Zerlina, I'll make sure to flag that as it comes out for the future client meetings that you have. So I know we've covered a lot here. I wanted to maybe shift to some of your perspectives that you got during your meetings and how clients, we ask all of our clients here in the US, and I was recently in Canada talking about this, how they're using AI. What are those conversations like in your recent trips in Korea and mainland China?
I think in Korea, many asset managers and lifers we spoke with, they have enterprise license with AI agentic platforms such as Claude. This was very widely used by most of our clients, and the whole company is using this to help them to do Excel spreadsheet. We have some alternative debt investor platform managers telling us they're using Claude to help them screen the GPs. They're looking for Claude to do the analysis of their underlying BSL loan portfolios. They're dumping all the legal term sheets into the agent platform and asking it to come up with some reports. They're also using them to do presentation slides. Basically, it does sound like they're not going to hire that many junior employees going forward. In mainland China, I feel like the pace of how financial institutions using AI is quite way ahead of other developed market, including the US. One reason is probably the token is much cheaper in China because of the open sourcing of all the large language models. Second reason is because the within the mainland China space, the data control or the data restriction is not as tough as in the overseas market. So for a lot of fund managers and analysts, they have some type of DeepSeek related AI tools on their headphones directly installed on their computer. They even can have some open Claude, that type of co-work assistants, help them to do reports, help them to do analysis. There's also an interesting AI platform called AlphaPy. I think a lot of our audience probably are familiar with AlphaSense in the US. It's a great tool helping you to do earnings, summarizing a lot of the management meeting calls and help you to automate the earning notes. So AlphaPy in China is a similar version as AlphaSense, so as the name, and it is much cheaper. It's only for a couple of hundred RMB per month. Everybody can have one. So most of the equity portfolio managers, they already have this type of tools. It's mainly target for equity investors because the information is more transparent. These AI agent platforms are trying to develop their scope within the fixed income space, but they do overcome a lot. They do come across a lot of challenges, particularly where they could get the data, the pricing data, and some of the bond related information. It's not publicly available, and also the bond investment community in China or in the offshore market tend to be a relatively smaller community with some chat groups set up on Bloomberg Messenger. You just cannot easily replace. But still, I think there is a lot of funding for these AI platforms from the government side as well as from the SOEs. We also got the sense that the financial institutions in China now they have huge AI infrastructure related budget. And this sounds like much bigger than what they have for the research and investment side. Not a great story for us, but that seems like this AI is moving fast, very fast in mainland China.
That's interesting. Just a couple hundred RMB per month. I don't really know the enterprise pricing over here, but my sense is it is drastically higher than that. It's interesting because, I mean, was it 2025 with the DeepSeek revelation in late January and the market it's crazy how quickly we just jump from thing to thing and the past thing kind of falls by the wayside, and you have to wonder what it would take to sort of bring that back to the surface. And we had that with software before the Iran war. Yeah.
Yeah, we got a lot of overseas investor asking what happened to DeepSeek. How come we don't see any news about DeepSeek? Are they just like stagnating, not doing anything? But I think it's just the market attention is diverted towards private credit or the Middle East tension. So nobody's not really paying that much attention, especially for the fixed income investment community to what's going on. But my sense is it's advancing very fast in China across different asset classes.
And I mean, it's crazy to consider, we're calling for 750 billion of AI capex by the big five hyperscalers here in the US. If ultimately that is not proven to be necessary or doesn't generate a reasonable return, when do market participants start to penalize for that? And I feel like that's something that we've kind of considered and factored into our overall spread call this year. And I think you've seen some signs of concerns in terms of how much debt is coming to market. I think the Oracle and Alphabet deals went well. Amazon maybe a little bit softer, and that's more like what we expect to see going forward here in the US. So I feel like there's a lot of big macro themes to consider. Meanwhile, we have headlines about the state of the Iran war every day. It's hard to take it all, distill it into what could be considered a concise and easy to understand investment thesis in this market.
Yep, it's for Chinese investors probably too much information to process because they just own so much data and so many agentic platforms to help them. But in the end, it's very hard to get the conclusion. That's the general complaint I also get in all the meetings.
Interesting. Well, we've got a lot to consider. Zerlina, is there anything that we missed that you wanted to highlight from your trip in terms of interesting takeaways?
I think maybe the other thing to mention is JGB yields are really going higher over the past 12 months. We are now hearing a lot more non-Japanese investors talking about the value investing in JGBs. Interestingly, the domestic investors don't really look that keen to reallocating their USD fixed income investment back to the JGB market, given they think the overall yield are still not really that attractive compared to the dollar, and the dollar hedging cost has the hedging cost for investing in dollar fixed income market has come down quite dramatically over the past few years, and it's very difficult to get long dated paper in the in the Japanese yen corporate bond market because most of the corporates, if they want to issue long dated paper, they would counter the dollar bond market. So domestic investors are still quite interested in the overseas dollar investment. But Taiwanese investors, for instance, and some of the Korean investors we met this time, they are very interested in JGBs. Basically, they want to borrow at the short end and then do a carry trade, invest in slightly long dated JGB. The trade from time to time would work out, but the JGB curves is relatively volatile and they sometimes move in tandem with DM rates. So this trade also does not work out all the time. So I think since last year, there has been a lot of fund inflow into the JGB markets from the foreign institutional investors. This trend will likely continue. I think last year, in one of our bingo card, we say like the converge of 10-year bonds with 10-year US Treasury. I think might be an even more interesting bingo card if we say like 30-year JGB can converge with 30-year US Treasury.
I like that. I've been tracking what's going on, at the very long end of curves as the Iran war has transpired, and it was interesting to see. I think among the G10, Japan was the only one that had the 10s 30s curve steepen. That actually has since shifted. The curve has flattened so that on that since February 27th, we've also seen a flattener in 10s 30s for JGBs, which is the same for all G10 currencies at this point. And I think one of the things that's come out in the U.S., particularly chatting with clients and former colleagues, is just the hedge funds in particular got crushed by the front end, and the shift in expectations for the Fed, the Bank of England, I think has been the worst. The ECB has been pretty incredible, and I think that caught a lot of people offsides, thinking that at least continued easing in the U.S. was a pretty safe bet. And so being long the front end, maybe being long on a levered basis, felt like a pretty easy way to clip some carry, and that certainly blew up in a big way. All right, Zerlina, I think we covered everything I wanted to talk about. I really appreciate getting your perspective from recent meetings. This will be very helpful for me as I prepare for my meetings, which are still taking shape, and I plan to be over in Asia. It's looking like Taiwan and Hong Kong again in later July, sharing what will be our second half of 2026, first half of 2027 outlook. So I'm looking forward to that. I really appreciate your perspectives. It certainly helps me as I consider what I need to be talking about, maybe what views I have to defend the most stringently based on your discussion. So thanks again for coming on the podcast, Zerlina.
Thanks, Zach. We're very much looking forward to having you in Asia in July.
All right, I'm looking forward to it as well. And thank you all for tuning in. We will catch you next time on No More Risk Better.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.